It's Monday, the 3rd of August, 2020. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Sean Aylmer. The big four tech stocks, Apple, Amazon, Google and Facebook, report stunning earnings. Are they now too big? That's our main story. Also coming up in today's podcast, Victoria goes into a state of disaster as the COVID-19 pandemic hits crisis levels. James Murdoch leaves the News Corp empire, and petrol stations around the country about to get a revamp. Later in the podcast, I talk to AMP Chief Economist Shane Oliver about the outlook for the local and global economies. But first, here's a brief look at markets. The S&P 500 was up 1.7% over the last week, while the tech-heavy Nasdaq was up 3.7%. Now, the Nasdaq was up nearly 7% for the month of July, notwithstanding the surge in the number of COVID-19 cases in the US. Why? Because investors can't get enough of the big tech stocks. More of that in a moment. European markets were lower over the weekend, while the S&P ASX 200 fell 2% to 5,928 points on Friday, though over the full week it was up slightly. The second wave of infections in Victoria has weighed heavily on investor sentiment, and it's likely to keep doing so. Half-year earnings season kicks off in earnest this week. Both oil and gold prices were slightly higher over the weekend, while the Aussie dollar is trading around 71.5 US cents. 4 of the big 5 global tech companies reported quarterly earnings over the past few days, with 3 of them, Apple, Amazon and Facebook, outlining big increases in revenue and profits. The 4th, Google's parent Alphabet, said its sales dipped for the first time in 16 years, but the result was still better than expected. The share prices of the first 3 surged, and the market value of the 4 companies is now US dollars 5.2 trillion. That's about 4 times the total output of all of Australia each year. Starting with Apple, it outlined a very strong result for the 3 months to the end of June. Compared to a year earlier, every category of product in every geography rose. iPhone sales were about US $26 billion during the quarter, while the company sold about US $60 billion worth of products in total. About 60% of the turnover came from outside the United States. Apple's share price jumped 10.5%, and the company is now worth US $1.84 trillion. Yes, $1.84 trillion. The thing about Apple is that it's now so big and so influential that investors see it as something of a safe haven relative to other stocks. If you want to invest in a safe equity, put it into Apple. Now, next in line is Amazon. It's worth about US $1.6 trillion. The group managed to post its biggest ever profit for a single quarter. It was US $5.2 billion, sending its share price 3.7% higher. The group reported sales of $89 billion US, up 40% on a year earlier. Google's parent company Alphabet posted its first quarterly sales dip in 16 years. While search revenue was lower, revenue in all other parts of the company grew. Its share price actually fell 3.3%, but it's still worth US $1 trillion. The minnow of the lot is Facebook. That's worth a mere US $723 billion. Now, in case you're wondering, that's about 8 times larger than the biggest company listed on the ASX here in Australia. CSL, that is. Facebook's share price rose 8.2% after it said it had generated a big jump in revenue to US $18.7 billion. Daily active users on that platform is now 1.8 billion people, while monthly actives is 2.7 billion people. The performance of the companies is phenomenal, but that success does put them in the firing line of regulators, as seen last week in their appearances before Congress. There's a risk that legislators will work to curb their market power. The tech stocks now dominate Wall Street. While it's great news if you're a shareholder, it's not necessarily that good for the market and for the economy as a whole. The 4 companies, along with Microsoft, account for 20% of the S&P 500 on Wall Street. That's 5 CEOs with a lot of market power. That's not good for competition, and it's not good for pricing, at least in the long term. Investors in the world's biggest economy have become far too reliant on just 5 companies. all of which are in the same sector. While tech stocks have led the way during the COVID-19 pandemic, it won't always be the case. Their fortunes will turn, and the lack of diversification on Wall Street will be harmful to investors. In a moment, the rest of the news you need to know this morning. Thank you for joining Fear and Greed at the start of another week. As always, our commitment to you is to make sure you've always got the best summary of the day's business news in your playlist by 6:30 a.m. But the only way to guarantee you get it by that time is to subscribe or follow the podcast. It costs absolutely nothing and will give you everything you need to know for a successful day. Sounds like a pretty good investment to me. So please, if you haven't already, make today the day you hit subscribe or follow. Overseas news first up. India recorded nearly 55,000 new coronavirus cases in just 24 hours. Japan is also fighting a second wave, while the number of cases in the United States and South Africa continue to surge. The total number of coronavirus cases worldwide is now 17.9 million, with 685,000 deaths. July was a month when 1,000 advertisers boycotted Facebook as part of the Stop Hate for Profit movement organised by civil rights groups. Facebook has about 9 million advertisers globally, so 1,000 isn't that many, but it did include some pretty big names. Did it work? Well, no. Many of the advertisers are saying they will return to Facebook, and boss of the platform, Mark Zuckerberg, played down its relevance over the weekend, saying it didn't hurt too much financially. President Donald Trump said he'll ban TikTok from the US, the incredibly popular app that shows very short videos. The app is Chinese-owned, and Washington is worried that the government in Beijing could access information about Americans who use the app. Now, reports say that Microsoft is in talks to buy the US operations of TikTok to salvage the business. Locally, Victoria has gone into lockdown, entering a state of disaster after recording almost 3,500 new cases of COVID-19 over the past week, including 671 yesterday. Under new lockdown rules, residents can only leave their homes for the purpose of buying food, medical care, exercise, or work and education if necessary. They need to buy food within 5 kilometres of their home, and only one person per household per day can do so. Exercise must also be done within 5 kilometres of home, and only once a day for no more than an hour. Schools, TAFE and universities are going back to remote learning, and a curfew will apply across the state from 8 p.m. till 5 a.m. State Premier Daniel Andrews said the more severe lockdown was necessary to suppress the virus. The Premiers had preliminary discussions with Prime Minister Scott Morrison about greater economic support packages. Now, more than a quarter of deaths since February have occurred during the past week. That's 53 deaths out of a total of 208 nationally. Victoria's recorded 123 of those deaths, including 7 yesterday. National Australia Bank Chief Executive Ross McEwen warned that the tough restrictions will have a deep impact on families, businesses and the economy, but he added that they're necessary to protect the community. The bank is based in Melbourne. And Woolworths has reimposed limits in Victoria on dozens of products, including toilet paper, rice, pasta and several frozen foods. Now, in other states, there continues to be new cases, but nothing like Victoria. There were 12 in New South Wales yesterday, 2 in South Australia and 1 in Queensland. It's quite remarkable that there hasn't been more cases outside Victoria. The New South Wales Premier, Gladys Berejiklian, said she was now strongly recommending people wear masks on public transport and in supermarkets, in places of worship, in hotspots around Sydney, and if you're a customer-facing employee. James Murdoch, the second son of Rupert, has resigned from the board of publisher News Corp, citing disagreements over certain editorial content published by the company's news outlets. He no longer has any ties to his father's publishing group. James has always been a little more left, shall we say, than his father and older brother Lachlan. He's also championed environmentalism and been a critic of President Donald Trump. Now, they're positions which conflict with his family's news businesses. Telstra suffered a major outage to its network across Sydney, Melbourne, Tasmania and Canberra yesterday. Initially, reports suggested it was a result of a cyber attack, though later in the day the telco said it wasn't. Visy Industries will spend about $500 million to make beer bottles lighter and more recycling friendly. In an interview with The Australian over the weekend, head of the family-owned business, Anthony Pratt, said manufacturing had never been as important in Australia as it was now, particularly food manufacturing. It's Monday morning, and as has become far too normal, the results from the weekend auctions are disappointing. Again, it's Melbourne struggling most. Listings have tumbled in the Victorian capital, down about 50%. The clearance rate in Sydney over the weekend was 68%, and in Melbourne it was about 60%. Now, the numbers aren't a disaster, they just aren't that good. Adelaide and Canberra had relatively strong 80% auction clearance rates. If you've wondered why so many Puma petrol stations have started popping up, well, wonder no more. Now, the network is owned by energy giant Chevron, having been purchased from independent owners about 9 months ago. Puma now has 360 sites across the country, and all are about to get a rebrand to become Caltex. The old Caltex servos are now Empol. Getting confused? Me too. They all serve petrol. That's all you need to know. But staying with Chevron, that's the one that owns the Puma/Caltex brand. The group says it intends to develop renewable energy projects in Western Australia to help power its LNG operations as part of its push to generate more carbon-free electricity. Most of the major global oil players are taking the same path. Shell, BP, Francis Total, and Italy's ENI have all said in recent months they'll make reinvestments to reduce their carbon footprints. Super Retail's share price jumped almost 10% on Friday after the group, which owns Supercheap Auto, Rebel Sport and BCF Camping, said it had enjoyed a surge in sales in June as people emerged from lockdown. There's been pent-up demand for fitness and sporting goods, and people had spent more money on cars for road trips in their home states. Its full-year revenue last financial year was $2.8 billion, up from $2.7 billion a year earlier, despite the coronavirus. Nice to end the news section on some good news for a change. This morning on Fear and Greed, we welcome AMP Capital Chief Economist Shane Oliver. Morning, Shane.
Good morning.
The big news over the last week was inflation and, in fact, deflation. Should we be worried?
Not necessarily by what we heard in the June quarter. I mean, I guess it's quite common now for people to sort of want to worry about everything. And if I watch the TV at night time, I get myself very depressed. So the last few weeks, I've managed to turn that off and watch The Bachelor in Paradise, which is far less.
which is anything but. It is very entertaining. I'm with you on that.
And in times like coronavirus, when you're getting yourself depressed watching the nightly news, at least you can turn that off, watch The Bachelor. So there is a lot of bad news out there. The deflation number, which came out on Wednesday, on the one hand, you can say that's depressing. You know, the last time we've seen a number like that, well, in fact, in the CPI, it doesn't exist. In the whole of the 72-year history of the CPI, you've really got to go back to the 1930s to get a 2% or a 1.9% decline, but they don't have the CPI back then. But in any case, so that's bad. Flip side, though, is that the reasons it fell actually helped people. We had free childcare, we had free before and after school care, and in some states we had free preschool. So those things knocked about 2 percentage points off the CPI, and we also had a 20% plunge in petrol prices. So that all sort of took a bit of pressure off Australian households through that period. So you could argue it's probably a good thing. The concern will be, though, if it continues, if you continue to see deflation, not just in the headline number, but in the underlying price series through time, then that would start to raise the question that we might get stuck in a slippery slope of a deflationary spiral where falling inflation numbers lead to falling wages, which then leads to further falls in inflation. And before you know it, it gets harder and harder to service your loan because your income's going down. So I think that's something we do need to worry about. But the factors that drove the deflation in the June quarter aren't really that worrying because it was mainly petrol prices. We like lower petrol prices and free childcare, and we like free childcare.
A lot of fear in this particular episode of Fear and Greed, Shane, I've got to say. Not too much good news, apart from The Bachelor in Paradise.
That's right. That's a bit unfortunate, but there has been some good news in the last week or so. Kylie Minogue released a new single Thursday week ago, and Taylor Swift also released one. No one knew the Taylor one was coming out. And I should just I mean, there's a lot of negatives around the share market and the economic outlook, and we know them all. We're reminded of them regularly. I might just run through a list because it's always helpful to keep these things in perspective. But the big negatives are obviously rising coronavirus cases globally. That's still going on. We're seeing a pause in reopenings, or in some cases shutdowns. Obviously, Melbourne got very high unemployment. We've got the hit to earnings. We've got the US election, which President Trump
might delay that one.
It's Congress who will determine whether it's delayed or not. And so far, they've said no. And then we've got US-China tensions. And, of course, this period we're now in, coming into August, September, is known for volatility or it's seasonally weak in the share market. They're all the negatives. The positives, though, are that we are getting good news in terms of various treatments. Obviously, remdesivir, there's a steroid there and a few other things. Some positive news in terms of vaccines. We've got the second wave in the US being less deadly than the first. Now, it's horrible whatever way you look at it, but the fatality rate in the US has been running around 1.5% just over the last few weeks, whereas in the first wave, which mainly hit New York and hit mainly older people, fatality rate was up around 7%.
Wow.
So therefore, the sense of community depression is perhaps not quite as great as it was back in March and April. And we've got several countries have still shown that if you're careful and wear masks and do the right things in terms of distancing, you can keep it under control. So far, most Western countries have failed on that front. China shows that you can trace out a deep V recovery if you put your mind to it. The US dollar, which was going up earlier this year on the back of safe haven demand, it's been falling, which is often a positive sign. You've got massive monetary and fiscal stimulus, and also low interest rates and bond yields make shares look cheap. And as far as I can tell, there's still a lot of money sitting on the sidelines. And you've only got to look at money supply growth in Australia and other countries around the world to just see the pile of money that's going into bank deposits. Now, eventually, some of that money will come back into the share market. So there are a bunch of negatives out there which are going to mean for the next little while it's probably going to remain a volatile and rough ride in shares. But hopefully that's kept to being a correction as opposed to a new downswing, and the positives should ultimately win through and push markets higher.
Thank you, Shane. Thanks for talking to Fear and Greed.
My pleasure.
That was AMP Capital Chief Economist, lover of The Bachelor in Paradise, and as we've just found out, somewhat of a specialist in female pop singers, Shane Oliver. Now, my extended interview with Shane Oliver is available right now as bonus content, and there's a lot that we couldn't fit in. I know I say this a lot, but this is one interview you should really hear. He's got some great insights into the US economy and whether the old adage is still true about when the US sneezes, the rest of the world catches a cold. He also tells us what to expect from the rest of earnings season locally and the factors he's looking for a signal to recovery. All that and why he feels like he could relate to last season's Bachelor. It's in our extended interview. Make sure you subscribe or follow Fear and Greed to find it in your playlist. It's been terrific to see so many recommendations coming from listeners on social media. Shout outs to Fear and Greed on Twitter and Facebook, and this one from Jamie Wood on LinkedIn. The best ideas are the ones where you go, why didn't I think of that? Enter Fear and Greed, a brilliant daily business podcast. For anyone chasing a quick summary of what's going on in our domestic and international business, this is an essential part of the morning routine. Well, thank you, Jamie. We're glad you're enjoying it, and thank you for telling your network about us. We're an independent podcast and rely entirely on word of mouth to get the word out there. It's Monday, the 3rd of August, 2020. I'm Sean Aylmer, and that was Fear and Greed. Enjoy your day.